Yo, I ain't here for the money, I ain't here for the fame. Though it might be nice to own a jet plane, I'ma do it all for you.
Traders, I got your watch list for June 14th. Let's run a quick recap of today's trading session, then dive right into our watch list. On Tuesday, June 13th, 2023, the stock market experienced gains as the inflation rate slowed down. The Consumer Price Index, CPI, for May showed a headline inflation rate of 4%, its lowest in over 2 years. This data, while in line with expectations, relieved some pressure on the Federal Reserve, Fed, indicating that they are likely to hold off on raising interest rates at their upcoming meeting. As a result, cyclical sectors and small-cap stocks performed well, and government bond yields increased. Additionally, Asian markets received support from reports suggesting that China may implement broader stimulus measures. In the oil market, prices rebounded by 3% after a 4.5% drop on Monday, attempting to reach the $70 mark. The CPI data for May indicated a 4.0% annual increase, aligning with expectations and significantly lower than the 4.9% reading from the previous month. This marks the smallest annual increase since March 2021 and the 11th consecutive month of improvement since inflation peaked at 9.1% in June of the previous year. Lower energy prices, particularly WTI oil, which declined from $106 per barrel in May 2022 to around $72 last month, played a significant role in the decline in headline inflation. Core inflation, which excludes food and energy, decreased from 5.5% to 5.3% and rose 0.4% month over month, similar to the trend in April and March. Key contributors to the monthly increase in core inflation were shelter, used car prices, and vehicle insurance, while airfares and household furnishings experienced declines. The rise in goods inflation over the past 2 months was primarily driven by higher used car prices, which are not expected to persist due to increasing inventories and indications of further declines. Housing remained the main factor contributing to the monthly increase in inflation, but it is anticipated that shelter inflation will decrease in the coming months based on historical lags. The super core measure, which excludes housing and focuses on core services inflation, showed the slowest pace of increase in 15 months. However, it still does not align with the Fed's 2% inflation target. The deceleration in inflation is a positive development for the Fed, but it is unlikely to significantly alter their expectations. The strong labor market and overall economic performance will keep the Fed cautious and vigilant against premature actions. However, given the aggressive rate hikes over the past year and months of disinflation, it is expected that the Fed will adopt a more patient approach. The consensus is that the FOMC will refrain from raising rates at the upcoming meeting, signaling in their statement and projections that they may consider future rate hikes depending on data. It is possible that there will be a rate hike in July following the pause in June. The anticipation is that weaker growth in the future will eventually lead to the conclusion of the current cycle of interest rate increases that started 15 months ago. Notably, Economist Mohamed El-Erian warned that the Fed might be making a mistake if it chooses to skip a rate hike this week. El-Erian argued that skipping a hike could be the least desirable option for the central bank and that it may not significantly enhance their understanding of the effects of their policy tool. He suggested that the Fed should either raise rates again or pause their tightening campaign while adopting a new inflation target between 3% and 4%. Jeremy Siegel, a markets guru and retired Wharton professor, expressed caution regarding the stock market rally. He predicted a mild recession, stating that the Fed is unlikely to raise interest rates further. Siegel emphasized the importance of unemployment data in determining the Fed's future actions, suggesting that if the labor market weakens, the central bank may halt its tightening measures to avoid causing significant job losses. Additionally, Jeremy Siegel suggests that the Fed might raise its inflation target from 2% to 3% once the current threat fades. This would give the Fed more flexibility to lower interest rates during economic downturns or if factors such as an aging population and declining productivity start to impact growth. In summary, Mohamed El-Erian argues against skipping a rate hike, emphasizing that it's important for the Fed to continue its efforts to control inflation. On the other hand, Jeremy Siegel predicts a mild recession and suggests that the Fed might not raise interest rates further to minimize job losses. It's important to note that these are the opinions of economists, and future market movements and Fed decisions are subject to various factors and uncertainties. On to our watch list, we are keeping an eye on several stocks for potential opportunities. One of them is AI, which recently broke out of its consolidation zone on higher volume. Investors are looking for higher highs, with a long idea over $45. Another stock to watch is KLR, a direct competitor to Twilio. While Kalera is not the largest company, it has shown significant price gains in the past couple of weeks, making it an interesting prospect. However, based on a discounted cash flow valuation, Kalera appears to be overvalued by 38% at the moment. If you are interested in the stock, it may be worth keeping an eye out for a potential price decline in the future. Moving on to Chinese stocks, the People's Bank of China surprised the market by lowering its 7-day reverse repo rate from 2% to 1.9%. This unexpected rate cut has led investors to believe that more stimulus measures could be on the horizon. Shares of Alibaba, Bilibili, and Baidu have seen positive movement following this news, with investors speculating on potential future stimulus. Economists at Goldman Sachs expect further rate cuts in China later this year, as well as potential relief for banks through reduced reserve requirements. While China's economic rebound initially showed promise, recent mixed economic data suggests that the recovery may be losing momentum. Nomura Holdings chief China economist, Lu Ting, points out that high debt levels in China could limit the effectiveness of traditional stimulus tools. However, stimulus measures are still expected to support Chinese stocks in the near term. In the United States, tech stocks are also experiencing upward movement after May's Consumer Price Index, CPI, rose by 0.1%, in line with estimates. The annual inflation rate of 4% is the lowest in 2 years, leading traders to believe that the Federal Reserve will leave interest rates unchanged following its June meeting. In conclusion, economists and market analysts hold different views on the future course of the Fed's monetary policy and the overall market outlook. Mohamed El-Erian argues against skipping a rate hike, emphasizing the importance of continuing efforts to control inflation. Meanwhile, Jeremy Siegel predicts a mild recession and suggests that the Fed may not raise interest rates further to minimize job losses. As with any financial predictions, it's important to consider various factors and uncertainties that can influence market dynamics and central bank decisions. Thanks for tuning in. Your engagement helps us a bunch to create these time-consuming videos, so be sure to subscribe, like and comment what you're watching tomorrow.